Good day, everyone, and welcome to One Invest Think Forum under the theme Unlocking Opportunities. In today's discussion, we'll be discussing megatrends, how an increase in the number of available indices is putting more power in the hands of asset allocators. My name is Lungile Macuacua, and I'll be your moderator for today's discussion. So we have an insightful conversation ahead, featuring a very distinguished panel who will unlock how the evolution of available indices is reshaping asset allocation and investment decision-making. Before we dive in, let me introduce our panelists. Joining me in studio, we have Len Jordaan, who is the head of client coverage for South Africa and Sub-Saharan Africa at S&P Dow Jones indices. And joining us virtually, we have Omar Moufti, who is a director at BlackRock, who is the member of the iShares EMEA Equity Product Strategy team, leading the sector, thematics, and commodity pillar. Gentlemen, thank you for joining me today.
Thank you. Thank you, Lungi. Be here.
We'll get started. So, indices have come a long way from broad market benchmarks to more thematic indices that we're seeing today in market. And today we're seeing an unprecedented increase in thematic and alternative indices. And we're seeing that investors are increasingly seeking to build their portfolios in a more diversified way by unlocking all of these opportunities that are becoming available. I mean, we can look at factors like value, size, momentum, low vol, and the like. And we can also look at some themes that range from AI to blockchain to cryptocurrency to clean energy. But before we get started on discussing and unpacking some of those, I'm wondering, Len, if you can just walk us broadly on the evolution over time from broad market benchmarks to what we're seeing now, which is more specialized themes.
Yeah, thanks, Lungile. You correctly said, market cap indices were the first iteration of indices. They were really designed to give people an indication of the performance of an entire market. So to use an example of the USA, the S&P 500 is considered to be the benchmark index, and what that does is it tells people how well the US market is performing overall. What market participants started to ask for is it possible to use indices to get a more granular indication of how particular shares are performing within that universe of stocks? And so the second iteration of indices that came was therefore sector indices, which essentially broke down companies into groups that had the same function. So we saw industrial shares grouped together, we saw financial stocks grouped together, and we saw resource stocks all grouped together, and we created indices on those to give an indication of how those groups of stocks were performing. Then asset managers, active asset managers, started implementing different strategies in their portfolios, which we refer to as risk premia or factors. And so they started asking us, can we group companies according to different parameters? And those parameters were things like value. Can we see how well companies that trade at a discount to their fair value have performed, or companies that have a lower volatility than the overall market? Can we see how those performed overall? And so index calculation agents came up with what we call risk premia indices or factor indices, which group companies like that and are able to give investors an indication of how those groups of companies perform. What we've seen more recently, and I think we'll dive into the reasons for it and what's facilitated it later, but investors have started to think about the world and constructing their portfolios in terms of themes. And an example of a theme would be, for example, electric cars. Investors would say to us, can you show us how companies that have exposure to the investment car industry have performed? And those companies may come from a variety of different sectors. So you may have the companies that manufacture the cars, you may have the companies that manufacture the batteries for those cars, or the mines that mine the elements that go into those batteries, or the service companies that run the recharging stations for these cars. So that they may come from all different sectors, but they're exposed to the same ecosystem, the same industry being electric cars. And that's really been the evolution of indexation and how it's getting more and more granular to stay relevant in investments for now.
Yeah. Perhaps could you shed some light on what has driven this shift, and if the same applies in what we're seeing globally to what we're seeing locally in South Africa?
Certainly, I think what's driven it is demands from investors. Investors are saying to us, we need indices that are relevant, and that's active managers and passive managers. So active managers who follow particular strategies need a relevant benchmark to measure their performance against. So we try to create relevant indices for them to do that. What's facilitated it is the fact that there's far more data available to companies like S&P that we can analyze and that we can group certain companies into different roles. But not only the volume of data has improved, but also the quality of the algorithms used to analyze that data. There's far more ways to analyze data now than there was 30 years ago. And so we're able to cut and slice data in far more interesting ways than was previously possible, and service the active and the passive management industry in that way.
And Omar, would you paint a similar picture around the evolution of indices, or have you identified other key drivers in the markets that you do cover at BlackRock?
Yeah, I'd agree with everything that Len said. I think clearly the advances in data sets have been a key driver in moving away from what were crudely and very broadly constructed indices, such as based on geographic location or based on broad sectors, to being able to convert what we're seeing in the real world into investment ideas. And I think it was very much started as a grassroots, the growth in thematics very much came from the grassroots. It was end client retail investor demand asking to be able to invest in the changes and the advances that they're seeing in their day-to-day lives. But over time, that's grown into the wealth segment and increasingly into the institutional segment because, well, wealth also likes to see a portfolio that is relatable, that is understandable in a way that, it's hard to say for, say, the S&P 500. And on the institutional side, because much of these themes address long-term structural change, and that aligns nicely with the investment horizon for many institutional investors who are investing not for where the market is today or will be in the next quarter, but really for the long-term drivers of growth over the next 5-10 years, the megatrends or mega forces as we call them at BlackRock.
Okay, no, that's very clear. And both of you are touching on a very important thing, which is just the sheer amount of data that's required to even make these indices available. And it wouldn't be a discussion about megatrends if we didn't really spend some time actually analyzing or unpacking how important of a role do you think technology is becoming as a tool in the evolution of indices? So in your view, how important of a role has tech really played in terms of making these indices so readily available? And that's from a data processing all through the entire cycle, really.
Technology has played a huge role, especially the indexation of these thematics. To go back to the timeline, thematics began as an active endeavor because you needed an active manager to really discern which companies were related to which themes. But as Len said, the proliferation of much more granular data in itself, that granular data aided by tools such as AI that is able to analyze that data and categorize a lot of different information into a more structured approach has enabled, thematics. In particular, if I look at some of the very concrete elements behind it, we granular revenue data that no longer assigns one company to one sector or one industry, but breaks down what are very diversified companies into their multiple revenue streams has been very useful. The expansion of ESG data allows us to ensure that certain companies that are involved in practices that we deem unsustainable over the long term can be excluded. And over time as well, as thematics has grown and investors tend to seek more nascent exposures, we've even looked into what are precursors of revenue data. And here we're using very granular patent data as well to see, which companies are exploring or already investing or researching the future areas of growth. There's one thing that I probably failed to mention. On the proliferation of exposures, I think a key a key axis of development for us has been not just to launch product, but also to help in terms of services and for allocation, providing indicators, providing signals, providing outlooks to help asset allocators discern when is the right time or what exposure is right for this specific portfolio. And I think that is one of the key focuses going forward as we deal with a wider number of investable opportunities.
Very clear, very clear. And I'm just wondering, as we're speaking, gentlemen, if there isn't a risk at some point as we're seeing this evolution progress, if there isn't a risk in the market of potential oversaturation within thematics. Have you seen this trend, or do you think it might be something that does come up, where there's just too many of these thematic indices? For example, if we look at ESG, we've had investors really show a keen interest in wanting to have more ESG funds, but that doesn't quite translate into inflows into these specific funds. Or there's just too many of them that investors really end up not knowing which one is which and which one actually does what it says it does.
I think that's a fair point. I mean, there has been a lot of new indices issued, and there may be some confusion for investors out there because there are so many. S&P does issue indices that we use our best endeavors to try and meet investor demands as we perceive them, but we also sit down with some of our bigger clients and create indices with them so that we understand exactly the kind of risk parameters and flavor they want to include in the index construction process. And also we're not immune to cutting indices that no longer become relevant. So, we don't want to sit with a whole bunch of indices on the shelf that don't attract assets. We'd prefer not to issue them in the first place, but certainly if they aren't successful after a number of years, we will cut them because they clog up our machinery as much as they confuse investors as well. So, I mean, it's a fair point. I think a lot of it is demand driven. So usually clients will come to us and say, this is the theme we've identified. How best can we access it, rather than us as an index calculation agent saying, these are themes we think you should be investing in. We would never do that that's not our role in the financial markets.
Oh, it's very clear, very clear. And yes, Omar, you wanted to add?
Indeed, there's been a proliferation of the number of indices, of ETFs, of the thematic nature out there. I think that is potentially a good thing. I think choice is good, but I guess you can reach a state where choice becomes bewildering for the end client. And I think first that speaks to a continued role and a very important role for asset allocators in this, to select who are the most robust providers, the best indices that are the best constructed to track a theme and to achieve your investment objectives. And furthermore, I think it's also it speaks to the potential for the asset allocation community to deliver more advanced portfolios, ascertaining where are we in specific cycles, whether it's, I think Len mentioned, in the electric vehicles or in AI or in clean energy, understanding where we are in the cycle and allocating as well at the right time, and bringing multiple very interesting things into coherent and cohesive portfolios. And that's very important as we've seen a commoditization of beta, as the ability to get broad beta via global equity indices has become very easy. I think that is the huge opportunity for the asset management community, is to deliver these forward-looking, more advanced portfolios.
And all of these indices that we're speaking of, gentlemen, I'm just wondering, who are we seeing as the primary users? Is it a balance between institutional, retail, and what are you seeing in the South African market, Len?
ETFs per se tend to be retail-focused products, but certainly the thematic indices are probably best used in the hands of institutional investors who understand the unintended consequences of investing in those type of themes. These themes are not risk-free, and so by investing in them, you are taking some risk in your portfolio, and you need to be aware of that. But that said, South African institutional investors are using ETFs more and more. Technology has enabled them to access not only JSE-listed ETFs, but also ETFs that trade in London, which has given them a very big choice. And it also allows them to complement their exposure that they're getting in their South African portfolio. South Africa's market is underweight particular sectors, for example, tech. ETFs, whether listed in South Africa or offshore, allow South African investors to complement their portfolio and upweight sectors that they underweight in the South African market.
And Omar, are you seeing the same trend in terms of the key users of these indices globally?
I would say that in Europe, clearly there is a predominance of thematics in retail and wealth portfolios. Clearly because of that, the relatability of these themes, these indices, these ETFs to what they're seeing in the real world, and usually using this as a complement to broad equity market indices. I think, as Len said, these are much more narrower indices that have higher degrees of risk, and that has to be balanced out. But the trend in terms of growth is also towards more institutional approach, as we've seen actually stock selection from certain institutions diminish. What we're seeing more is selection of specific granular indices and operating in the same way stock selection used to operate, doing that on thematic and sector indices.
I'm wondering now, gentlemen, if we can just progress to essentially what came first. So conversation and debate around causality. And there's often debate in the market about, did index tracking drive the proliferation of these available indices, or did the availability of new indices drive what we're seeing in the index tracking market? So I'm wondering then if you can just give us a perspective of, in your view, what really came first.
In my view, I think ETFs became quickly the dominant or the preferred investment vehicles for many investors because it reduced friction between investors, effectively investors accessing the funds that they wanted to invest in. And as that ETF pool became a very large pool of assets, I think it was very clear that there was an opportunity to do more than just the basic indexation that had initially allowed this growth. So I think that the first starter in there was the proliferation or the growth in AUM in ETFs that allowed for a proliferation of indices. Now that said, I think today it is what some would call reflexive or self-reinforcing, in the sense that the more indices there are, the more investors are turning towards ETFs and indexation for their asset allocation and in their portfolios, and that itself is also driving more innovation in the indexation and ETF sphere.
That's very clear, thank you. And Len, moving to you, do you think there are any structural differences that make adoption easier or more challenging in South Africa relative to what we'd see, for example, in Europe or in the US?
So we try not to benchmark ourselves by the US market because the ETF industry has very specific advantages over the mutual fund industry that we don't have in South Africa. So I think we would tend to look at the European or UK market as more of where we could get to. South Africa is really small from an ETF perspective still, but growing really rapidly. But no, I mean, I think that the advantages of indexation apply equally globally. We release a research report twice a year called the SPIVA, which compares active managers to their benchmark, and it certainly shows that the benefits of indexation apply equally globally. So no, I don't think there's any structural reasons why we shouldn't see the same sort of inflows into index funds, whether they be ETFs or mutual funds in South Africa.
Very clear. And moving to you, Omar, how would you paint a picture of how the geographic shifts that we're seeing and a lot of the economic transformation that are unpacking in the market are affecting index creation and investor preferences?
We live in a constantly evolving world, and I think the reality, the real world is what drives the needs for indexation. And I think one thing, for instance, that we've noticed in the past few years is the rise of geopolitical tension. And that's occurring in multiple nodes across the globe. And what we've seen is, for instance, increased flows to themes that respond to that need, or that, to be fair, benefit from it, whether it's defense or gold-related exposures. I think what we're seeing increasingly is that the proliferation of indices is allowing investors to really achieve their desired outcomes more easily than it was once possible.
And Len, for you, what other mega trends are emerging, specifically if we look at tech and how mega cap stocks are essentially dominating some of the indices that exist, particularly looking at FANG stocks?
So it's interesting that you mentioned the FANG stocks because they have made up a very big portion of the S&P 500. I think at their peak, FANG stocks, or the top 10 stocks in the S&P 500 made up almost 30% of the total market cap of the index. In response to that, we launched an index called the S&P 500 Equal Weight, which equally weighted all of the stocks in the S&P 500. So it used exactly the same shares, but just weighted them equally rather than by market cap. And a lot of investors have switched from the S&P 500 into the equal weight version just because they weren't happy with that concentration risk. At the same time, though, we've seen other ETF issuers issue products on a new index that we launched called the S&P 500 Top 50, which only invests in the top 50 of the 500 stocks in the S&P 500. So while we've had some investors trying to take that concentration risk off the table, we've had other investors embracing that concentration risk and in fact trying to magnify it. So it's very interesting to see how asset managers and other market participants respond to the dynamics, and it becomes very difficult to predict how investors are going to respond because some see threats as opportunities and others see it the inverse of that.
Inverse. Okay. And Omar, what mega trends have you been looking at currently at BlackRock that you believe are going to shape the availability of indices or the increase, therefore?
We have a framework, what we used to call megatrends, we now call megaforces, and we have our 5 megaforces, which we think are those defining, structural trends that really are going to disrupt and dictate what happens, the big arc of what happens in the next 5-10 years. And I think they're very similar to what one would imagine. AI and digital disruption is one of them. The climate transition, the low carbon transition is another. We have the future of finance, which reflects what we think is the evolving role of banks and the continued disintermediation in the financial sphere, as well as demographic divergence. And I think that's something that probably speaks especially to South Africa and how the northern world is aging versus a still relatively young southern hemisphere as well. And I mentioned this earlier, clearly the big step change for this current period in history versus the last few decades is the reemergence of global geopolitical fragmentation, whether that's barriers or all-out war, frankly. And as this is our framework, and within this framework, we are constantly developing themes that we think can outperform over the long term and align themselves with this tailwind of growth around this. But I think it's important to always consider these in a portfolio context, right? It's easy to look at each theme on an individual basis, but this always has to make sense in a portfolio context. And diversification is one of the free lunches, or one of the only free lunches out there. So that means potentially mixing some AI theme, in which we have a lot of conviction and have done a lot of research on, with perhaps something more related to the low carbon transition, and perhaps, integrating a degree of hedge against the uncertain with something that is related to the rise of geopolitical tensions as well.
Yeah. And just looking at some 2 significant trends that we've seen for ETFs in recent years. Firstly, the rise in sustainable investment ETFs, and secondly, the rise in assets in actively managed ETFs. So for active ETFs, we're slowly seeing them surpass traditional mutual funds, particularly in the US, with a notable $3 trillion USD flow gap favoring ETFs. So then I'm wondering then if you could just paint a picture of what these actually are and what their potential use case can be in our market.
So ETFs have always been synonymous with index tracking because ETFs were originally designed to provide a portfolio that replicates the constituents of an index. What we've seen recently is exchange-traded funds, so mutual funds being listed on the exchange and therefore becoming exchange-traded funds, but the portfolio being actively managed rather than passively managed. In South Africa, we've certainly seen growth. It hasn't been as impressive as the rest of the world for the reasons that I've explained earlier. And I think that active managers are getting their heads around them. It's a paradigm shift for them in terms of how do you access that market, how do you sell the ETFs relative to mutual funds, because the methods of purchasing them are quite different from the traditional methods of purchasing unit trusts. We've also seen a domination by fixed income actively managed ETFs, and that would probably be the asset class, according to our SPIVA report, that has got the least benefit to be indexed. So certainly in the South African context, corporate debt and those kind of things are very difficult to index because those markets are quite illiquid. And that's where we're really seeing the opportunity for active managers in South Africa is fixed income portfolios. So that would really be my assessment of the market as a complete outsider. We do try to give these guys benchmarks to measure themselves against. So we're not totally excluded from the active management world. We're obviously far more involved in the passive industry, but as a service provider to the active management industry, it's a space that we watch with a lot of interest, and we hope that it grows.
And Omar, are you seeing the same trend, the same pattern when it comes to active ETFs in the markets that you cover? And do you anticipate that the growth will continue in those markets?
Yeah, absolutely. We do see strong growth in the active ETF market. I think it's very much testament to what we were saying earlier, is that ETFs have become the vehicles of choice for investing in general, not just for indexation, because of how ETFs have reduced friction to investment. And so we're seeing what was the traditional mutual fund market move to a different wrapper into active ETFs. And we think of the active ETF as three types. There's the alpha seeking, which is maybe the more traditional stock selection universe, outcome oriented active ETFs. So for instance, achieving a balanced portfolios or high income. And finally, a exposure oriented ETFs. And this is active ETFs. So think of active ETFs that may be managing cash, or maybe doing some fixed income where it was previously very hard to really get that exposure if you did not have the right infrastructure behind you.
And Len, any last remarks from you around what should be the key focus moving forward in terms of indexation in South Africa or globally? Anything that investors and asset allocators should really be putting top of mind?
I think for now, thematic indices are probably going to give local asset managers exposure to international themes. Our market probably doesn't have enough stocks to create thematic indices. And I hope that the local asset management industry embraces them and uses them in the way that they were intended to.
Awesome. Thank you, gentlemen, for joining us today for this discussion. It's truly been a fascinating one, and thank you for all the insights that you've shared. Before we wrap up, don't forget that in order for you to be eligible for CPD points, you have to stay for the entire duration of Think Forum, Unlocking Opportunities. But for the second session, thank you and happy investing.